Las Vegas home prices just hit $480,000. I've been watching this market for years, and what is happening right now is not just a cooling off or a correction. This is something bigger. Homes are sitting on the market for 55 days now, which is up 16 days from last year. That might not sound like much, but in real estate, that is huge. The real estate agents are all saying this is just normalization, just the market finding balance after the COVID craziness. But this doesn't feel like balance. When normal working families can't afford to live in the city where they work, that is not balance. That is distortion. When your city's economic foundation starts shaking, the housing market feels it first. Here is a stat that should make everyone pause. 23% of home sales in Vegas are going to investors. These are not families buying their dream home. These are corporations, hedge funds, and private equity firms buying up housing stock to turn into rentals. They are treating homes like stocks, like commodities to trade. And just like stocks, when sentiment shifts, when the numbers stop making sense, they sell. Fast, without emotion, without caring about the neighborhood or the community. Just pure profit calculation. The rental market tells its own story. Rents in Vegas have been climbing, but they are hitting a ceiling. People can only pay so much before they either leave or find alternatives. They may live with family, get roommates, or move to cheaper areas. When rents stop rising while property prices remain high, that gap between what investors paid and what they can earn becomes dangerous. Another cost that makes ownership harder and less attractive. The job situation is more complicated than the headlines suggest. Sure, unemployment is relatively low, but what kinds of jobs are being created? The service industry, hospitality, gig economy jobs, jobs that don't pay enough to afford a $480,000 house, jobs that disappear the moment tourism hiccups or the economy softens. The high-paying jobs that could support these home prices aren't growing fast enough to matter. Construction is another telling sign. New home permits are slowing. Builders are pulling back. They see what's coming. When builders who make money by building stop building, that's not because they suddenly got lazy. It's because they know the market can't absorb more inventory at these prices. They'd rather wait than build houses that sit empty or have to be sold at a loss. The psychology of the market has shifted too. That FOMO, that fear of missing out that drove people to bid $50,000 over asking, is gone. Replaced by fear of buying at the peak, fear of being underwater on a mortgage, fear of being stuck in a desert city with no water, paying a mortgage on a house worth less than you paid. Once that psychological shift happens, it is very hard to reverse. I keep thinking about 2007 in Vegas. Everyone said it was different. Population was growing. California money would never stop flowing. The entertainment industry was recession-proof. Then 2008 happened, and Vegas got hit harder than almost anywhere. Prices dropped 60% in some areas. Entire neighborhoods became ghost towns, rows of empty houses with dead lawns because nobody could afford to water them. We are not there yet, but the setup feels familiar. The first-time buyer market has essentially died. They're down to historic lows as a percentage of sales. Without first-time buyers, the whole market ladder breaks. Current owners can't move up because nobody's buying their starter homes. The market becomes frozen, dependent entirely on cash buyers and investors. That's not sustainable. That's not healthy. That's a market running on fumes. Local wages versus housing costs might be the most important metric nobody talks about enough. Teachers, firefighters, nurses, casino workers, the people who actually make Vegas function, they're getting priced out. They're moving to Henderson, to North Las Vegas, to Pahrump even. Commuting hours each way because they can't afford to live where they work. That brain drain, that service drain, it hollows out a city, makes it less livable, less desirable, less valuable. The luxury market is already cracking. High-end homes are sitting longest, seeing biggest price cuts. The rich aren't dumb. They see what's happening. They're not catching falling knives. When luxury buyers pull back, it cascades down. The move-up buyers can't sell their current homes to move up. The whole chain freezes. What really gets me is the disconnect between reported prices and actual deals. The median sale price might be $480,000, but that includes people who bought 6 months ago, when rates were different and when sentiment was different. Current deals, the ones happening right now with all these price cuts and concessions, are telling a different story. A story of a market that's already correcting, just not showing up in the official numbers yet. Short-term rentals, the Airbnb market, are another domino waiting to fall. Vegas was flooded with investors buying properties to rent to tourists, but tourism patterns are changing, and hotel prices are competitive again. The city has been cracking down on party houses. The easy money from short-term rentals is drying up, leaving investors with properties that do not cash flow at current prices. The demographic trends are not helping either. Las Vegas grew on the back of retirees seeking sun and low taxes, but retirees are reconsidering. The heat is getting worse. Healthcare infrastructure is strained. The cost of living is not that low anymore when you factor in air conditioning bills, water costs, and insurance. Younger people are not replacing them fast enough, not at these prices, not with these job prospects. Credit is tightening too. Banks are getting nervous. They are requiring higher down payments, better credit scores, and more documentation. The easy money era that inflated this bubble is over. Without easy credit, prices can't stay elevated. It's just math. Fewer qualified buyers means lower demand, means lower prices. Eventually. The commercial real estate situation downtown and on the Strip affects residential more than people realize. When casinos struggle, when retail struggles, when office buildings empty out, those jobs disappear. Those workers leave. That demand for housing evaporates. Vegas residential real estate is more tied to commercial health than most cities because of how concentrated the economy is. I'm not saying Vegas is going to become a ghost town. It won't. The city's too established, too important to Nevada's economy. But the housing market at these levels cannot hold. A median price of $480,000 with a median household income of $65,000 is a mathematical impossibility waiting to correct. The only question is whether it's a slow deflation over years or a sharp correction that happens fast. The smart money is already adjusting. Private investors are being more selective. Institutional buyers are pulling back. Builders are slowing down. Insurance companies are raising rates. Water authorities are implementing restrictions. These are not random, unconnected events. They are all signals pointing the same direction. The party's ending. The music's slowing down. And if you are holding Vegas real estate thinking it is going to the moon, you might want to reconsider. Markets do not go up forever. Desert cities do not have unlimited water. Working families cannot pay 7 times their income for housing. These are not opinions. They are facts. And facts do not care about sentiment or hope or what your real estate agent tells you. The Vegas housing market is at a breaking point. Whether it breaks slowly or all at once remains to be seen, but it is going to break. The numbers guarantee it.